In this lesson, we're going to look at a basic stock screener. Actually, you can use it for stocks, bonds, and mutual funds, and that's from Yahoo Finance. And so we're going to navigate to that in just a moment here, and I'll kind of show you how to use these kind of screeners, at least from a basic level. And then on the next lesson, we're going to look at more of an advanced screener where it gives you more options as far as to choose from, and that's something you'll probably end up using more. But first, let's get started with this basic screener here and look at how to maybe sort down from all the thousands of stocks and mutual funds down into something a little bit smaller to look at. Okay, we're over at Yahoo Finance. Actually, where you want to go, you can see at the top here, screener.finance.yahoo.com. So it's a little bit hidden as far as finding, but it's a nice, real good stock screener, something basic, something easy to use. So first thing you want to do when you come here is you can see you have a stock screener, you have a bond screener, and a fund screener. And since this is of course, we'll look at stocks. You can look at individual stocks here or at stock mutual funds. In fact, let's start by looking at stock mutual funds, just something real easy to take a peek at. Then we'll look at individual stocks and we'll kind of screen for those as an example. With all these examples, once again, I'm not making any recommendations as far as individual stocks or funds or anything of that nature. Just want to show you educationally how you can use a screener or use tools that can help you with your investing. So with that said, let's go to a fund screener. So I'm going to click on fund screener. You'll see how the screen has changed. And at the top, you'll see this overview and you have these different choices you can make. And that's the deal with these screeners is you basically make choices and it'll spit out some possible funds or stocks for you to take a look at. So the first thing is the category. We're looking at mutual funds right now, where we want to look for stock mutual funds. You can see you can look at any U.S. stock fund or hybrid, or you get into bond funds or all sorts of things. And as you scroll down, you'll see there's lots of choices. See, there's all these bond funds and stuff. But let's say we're looking at, let's say a large value fund, or let's do a mid cap. Let's do a large stock fund. Let's say a large value, which is kind of like both a blend of, or excuse me, not a value blend, but let's look at a large value. That would be like a dividend payer, or something that's we're looking at, dividend type stocks, or you could go growth or blend of the each. Let's go blend. Let's go growth. A blend, which is a blend of growth and value. So you get a nice mixture of stocks. You can choose a particular fund family if you want, different fund families out there. We're going to leave that blank so we can kind of choose from anybody. Rank and category, do you want to be a top performer? Are you looking for maybe a bottom performer? They'll rebound. Not so sure about that. But let's say we're looking for somebody, at least in the top 20%, maybe top 10% we can narrow it down. But let's start with the top 20. These ratings are from the Morningstar service. Morningstar also gives you good stuff with mutual fund searches and things too, and a lot more information beyond just the mutual fund's website too. And Morningstar gives ratings like on a 1 to 5 star rating. So, a 4-star rating is pretty good. 5-star would be the best. You can even get like a little information on returns, like high compared to other funds in that category, or low risk ones. We'll leave that blank for now. You can choose if you want certain performance measurements that you want to look at. No past performance, of course, is not a guarantee of future performance. But here you can see, let's say like a 3-year return analyzed, what that would look like. So let's say we were looking for a large cap blend fund, and we're looking for folks that maybe do better than 10%. Purchasing and fees, you can talk about initial investments, front-end loads, no-load funds, expense ratios. Let's see if we can find something below 1%. It might be a little harder to find, but let's see. And then you can go into different types of holdings, what type of cap, all that stuff. You kind of get that in the growth part. And you just basically fill in these basic blanks here. And then you can just hit find funds, and we'll see if any funds pop up. And as you can see, lots of funds came up. There's like the next 20, and you can see there's all sorts of these funds here. So let's narrow our search down a little bit. You can see the ratings, the rank, they're all in the top 10%. Morningstar ratings are all 4 or 5-star or better. Low expense ratio, good 3-year return. So large blend stocks. So let's narrow this down a little bit further. Let's say we like that information, but instead of the top 20%, we want the top 10%, and we want 5-star rated funds. And so we want the best of the best. And here you can see we narrowed it all the way down to 1 page. And you can see at least from a 3-year analyzed return, it's got them ranked, or it doesn't have them ranked, but you can see 3-year analyzed return, 5-star rated, low expense ratios, top 10% of their category, large blend, and that might give you an indication of some different funds that are out there. So if you like dividend funds, for example, this T. Rowe Price Dividend Growth Fund might stand out, and then you can click on performance or risk and get more information, right from Yahoo as far as, more information than on the T. Rowe Price. dividend fund, their ticker symbol, all sorts of information, their top 25 holdings. You got Pfizer, you can see these big, large cap stocks. So that'd be like, let's say, getting after a large, looking at mutual funds. Let's take a look at StockSo. Let's use this basic stock screener to look at some individual stocks. And same kind of thing. I clicked on stocks here. I got all these choices. This breaks it down by different categories or industry. You can leave that blank for anybody. But let's say we're interested in large pharmaceuticals, which in this part happens to be under drugs. So we're interested in drugs, right? Everybody's interested in drugs, right? But we're going to look at some drug, if I can spell, drug is spelled with a D. So we're going to go under drug, healthcare manufacturers. We're going to look at the major ones. Let's say we're looking for a high-end large company that pays great dividends that's in the healthcare market. That's what we're looking for. So we'll see if the screener can help do that for us. So we're going to look at drug manufacturers because we want a drug manufacturer. We could always go and look at this other too. But we're going to look at the big guys here and their major. You can choose if you want them to be hard index. You can look at their individual shares and market caps and all sorts of different things. Let's say we want big guys, so we want to have at least a market cap of, well, that's pretty big. Let's say 100 billion. Let's see what comes up. And let's say we want a dividend yield, so that's our a minimum dividend yield of let's say at least 2%. Maybe we want to go a little higher. And we want a high-paying dividend stock. That's what we're looking for in the drug area. So it's only going to pull up those drug pharmaceutical companies. Beta is, you remember, anything that's below 1 is less risky or less volatile than the index. If it's above 1, that means it's more volatile or more risky than the index. The price will change much more. So let's say we're looking for large cap, dividend payer, at least the index are less risky. So we got it as a minimum. We don't want a minimum. We want it to be a maximum risk of 1.0. So we don't want anything that's super, super risky as far as volatility. And then you can get into like sales margin, profit margin, if you were looking for certain price to earnings or price to book ratios or price to sales. If you like value stocks, maybe you want something with a low PEG ratio, which looks at price relative to its earnings growth, and then you can even look at analyst estimates and all sorts of stuff. But we want to get a start here and see what pops up. We can always narrow down later in this basic screener. And as you can see, for a basic screener, it's got good starting information for you to kind of narrow your choices down and then really dig in deep with the financial statements and different things. I just clicked Find Stocks at the bottom here. I'm sorry I did that a little too fast. Down at the bottom here, I click Find Stocks. And with that information, really narrowed my choices down. I got down to 5 drug manufacturers, major drug manufacturers. You can see they're all big, large market cap stocks. They're all doing at least a 2% dividend yield. Some are better than others, as you can see, and they're all below 1% in terms of beta. So if I'm interested in big drug companies, big market cap, pays a nice dividend, but really less risk, this might be good in a portfolio where you want some income but less risk. Here's some nice companies that are out there from this search. And you can see they're name brand companies, right? Johnson & Johnson, Merck, Novartis, Pfizer, Sanofi. These are big name, big known drug companies as far as, that you can then, compare and take a look at. And same thing, you could go into the profile, go on these different things and find out more information about them. So that's from the stock screener. I could go back if I wanted to. Oh, one thing it has here is a nice drop down too. So this is limited. It's got me my information. But let's say I wanted to look at some extra data. Like let's say I wanted to look at valuation, some of those ratios. I can just click it. And of my ones that I narrowed down, it shows me some ratios like price to earnings, price to book, price to sales, that PEG ratio, all that. So if I'm looking at, let's say, something with a low price to book, something might be a good value type of play, or with a low PEG ratio, maybe that's where Sanofi stands out. If I'm looking for something, with a nice price relative to its earnings, at least as far as this group, Johnson & Johnson and Sanofi, stand out as far as that. Once again, in comparison to the industry and comparison to the market, that's actually maybe a little higher price ratio, but you're paying more for, these good companies. That's the idea, is you're going to pay a good price for these, well-valued companies. And you can certainly look at their performance. Performance, of course, changes all the time, but it can show you, at least it's beta and all. It doesn't have return performance. You'd have to go back in there. So actively screened is what we looked for. All right, so there's a short little demonstration on the stock screener. Once again, you just choose your category, choose some information, and you can then at least narrow your choices down. And now that I've got my choices narrowed down to, let's say, 5, individual stocks, I can dig deeper and dig deeper into them and start doing more quantitative analysis and also more qualitative analysis as well. And then we'll also look at a more advanced screener where I can really narrow down and maybe do some more advanced things. That's what we'll look at in the next lesson as far as a more advanced screener. But to get started, play around with this screener here to get kind of started. And it's a nice little screener for the fun screener too. So it's pretty easy. Once again, screener@finance@yahoo.com. Give it a try and have some fun with it. In this lesson, we're going to look at a little bit more advanced stock screener called FinViz at finviz.com. We'll take a look at that. I'll show a demonstration of that for you so you can see something a little bit more powerful as far as narrowing down the thousands and thousands of stocks down there to maybe a few that you can then research further and find out more information, both quantitatively, the ratios, the numbers, and qualitatively from management, strategy, goals, all those kind of things that we learned about in the course, or learn about things as far as how to pick stocks. So right now we got to narrow our universe of stocks we want to look at, and this advanced screener can really help you with that. Two other things real quick. One, I don't make any recommendations, of course, on any particular stock. I'm going to just educate and show how you can use these tools to benefit you. And also, if you happen to use an online broker, an E-Trade, Scottrade, those kind of guys, TD Ameritrade, or a full service broker, they can do a lot of those things for you, and a lot of those online brokers like Scottrade and E-Trade, they have their own stock research tools as well. So if you belong to them, check out, see what they've got for screeners. But we're going to look at one that's free for everybody, and that's FinViz, and you can certainly give this a try. It's actually a very, very powerful tool. So let's go take a look at it. Okay, so we're here at FinViz. At finviz.com /screener. You can see it up here in the corner as far as how to access that, and or just search for FinViz screener. You'll be able to find it as well. And this is a little bit more advanced, maybe a lot more advanced screener than other screeners that are out there, and it's pretty good. It's really pretty good. And you can use it for looking at individual stocks, or you can use it to kind of sort through a whole selection of stocks. So right now when you get to it, you'll see listed by its name and ticker symbols here, ticker and company name. There's 300 and at least 359 pages. It keeps going. There's 20 stocks on an individual page. So you can see, boy, if I'm trying to narrow this universe, I'm down like at least over 7,000 stocks right there and more. So we need to narrow this down. And the nice thing with FinViz, it gives you these choices up at the top here where you can then kind of narrow things down as far as what you're looking for. And we'll go through an example here and then how to compare different stocks to each other as well. So this is nice for a comparison as well. So first off, we're right here and we want to start narrowing our searches down. So let's use for the example the same kind of thing where we're going to look for a drug manufacturer, dividend payer, safe stock that'll pay us a dividend. And let's see what kind of comes up there and see if we can kind of narrow this down and get some information how we get there. You can type in the individual tickers if you know some stocks and stuff, but let's say we don't know. We want to search the big universe of this here. You can see at the top here under filters, this is how it will narrow it down. If you wanted to be on a particular exchange, like a custom exchange, you have to pay to be that, or else the New York Stock Exchange. I never put anything in there because I want to search whatever I want to search on. The same thing with index and all that. But let's say we're looking for a high dividend paying stock, or at least relatively high dividend paying stock. So here I see dividend yield. So let's say I want it to be at least over 2%. I could go even higher, but let's say at least 2%. Well, you can see it's narrowed my choices down now. You can see there's Apple, all these different companies, all these different sectors, and it keeps going. There's over 105 now different pages of information. But let's say I want to narrow this down further. A good way to do that is by sector and industry. So if you want to kind of think about if I'm interested in a particular sector or industry, this is a way to narrow it down. So let's say we're looking in the healthcare sector. You can see all these different sectors here, consumer goods, financial, whatever, technology, you name it. And we're looking for healthcare sector. And you see my screen keeps updating. Now I'm down to 2 pages. So this is really narrowing it down because I'm at over 2% dividend yield. So anybody in healthcare who does not pay a dividend is not in my screen right now. I'm not going to be able to see that. And let's say I'm looking for large pharmaceuticals, right? I'm not looking at medical instruments or anything, but I'm looking at these large drug companies. So drug manufacturers, major, right? I click that. And boy, now I'm narrowed it down to 10 companies, right? So now I've got a nicer screen, a little bit more detailed of a screen versus like what we were seeing in Yahoo Finance, and more information, right? I can see the industry, I can see the country, market cap, price to earnings, just on this very first page, which is the overview. From here along the bottom, you can see more information too. But I could keep going as far as how I want to, sort this out. Maybe I want to, put in some more fundamental stuff. Right now I've got a dividend yield, healthcare, drug manufacturer, but I could click fundamentals here. And now I start seeing things like price to earnings, price to cash, these different numbers, debt to equity, things we learned about in some of our ratio type parts as far as if there's particular ratios I'm looking for. So for example, like a PEG ratio, price relative to its earnings growth, low price to earnings growth. If I'm looking for more of a value stock, I might want to look for a stock that's got a low PEG ratio, for example, versus like a high PEG ratio. So on different ratios we can look at long-term debt to equity, quick ratio, all those kind of things that are out there. So different choices that we have. So let's say I've got my dividend in there. I feel pretty good about that. But one thing with dividends, you can see in the lower right-hand corner here, is payout ratio. It's very important that they keep paying their dividends. And so the payout ratio, how much they pay out of their earnings each quarter in dividend, is important. And as we know, anything over 70% gets a little bit concerning. So maybe we're looking for something that's at least under 70%. Let's try that first and see if that narrows our field down. Well, that really narrowed our field down a lot, for something under 70% payout ratio, because that narrowed it down to, two stocks basically, this AbbVie's and this and Johnson & Johnson, and then we could keep going from there. But let's say we want it to be, we want to leave it at that 70%, and then we can then compare these two different companies. I'm very familiar with Johnson & Johnson. I'm less familiar with AbbVie, but you can see some of the information there. And then as you keep going through, you can see, valuation, here's a summary of the price earnings, the PEG, all that stuff, different numbers that you have for different pieces of information that are out there. Or you can go into financials, and same thing, you can find your ROA, which is a little hard to find in some places, return on assets. I can see my dividend yield. This is where my dividend yield is. You see where Johnson & Johnson's 2.71. AbbVie is going to pay me a better dividend yield at 3.6. And you can kind of see from there, different return on equity, return on investment, all these different things, debt to equity. Now, if I was to look at this, I'd say, wow, debt to equity and long-term debt to equity, a little higher numbers as far as with AbbVie. I might be a little bit more worried about them long-term versus very low debt to their equity for Johnson & Johnson. If we look at current ratio and quick ratio, those are, can I pay my current bills, as we learned from different ratios. And if I looked at this, I'd say you want bigger numbers here because you're looking at your liabilities versus your assets and liabilities and things like that, your current and quick ratio. So bigger the number, the better. You can see Johnson & Johnson much better for short-term ability to pay as well. So those are really good signs that I would look at for, I might be giving up a little bit in dividend yield, but I might feel better that they're gonna pay that dividend. You can look at ownership, you can look at performance, how they do in year to date, at least some quick numbers. You want to go a little bit deeper than this gives you, but at least gives you something over the last year and year to date. You can see Johnson & Johnson's doing better than them there as well, but past performance, no guarantee of future performance. You can do some technicals type stuff. Here's your beta is where you find, so you can sort by beta as well up in the top here, but or under here under technical. If I went to the top under technical, you can see beta as a choice here. Beta being a measure of volatility or risk. Anything above 1 is more risky compared to its index. Anything less than 1 is more or less risky and less volatile compared to the index. And you can see Johnson & Johnson below 1 is a less risky. There's less volatility. It doesn't change up and down as volatilely as high. And you can go through, you can do some custom stuff. You want to see some charts, they give you some charting stuff. Tickers is just the name of the ticker symbols, which we saw that, so we had to search for it. There's news, snapshot. You can get all the stats in one, you can't get all the stats in one spot. That's the pay one. But you can do a nice little snapshot where it gives you kind of the chart, a bunch of information, news, a description of the company, what they do, and different some insider trading stuff from the executives. So it shows you whether they're buying or selling, and you can get some information so you can dig a little deeper without having to go anywhere else. All right, so that's an example of, let's say, how to search for something as far as with these different type of companies. Real quickly, let's say I wanted to do the same thing. I wanted an overview, but I was not interested in healthcare. I'm interested in some other area, let's say financial. All right, So now it's changed. I've got the same numbers, but now I'm at financial companies. And maybe I want to we'll do one more quick here, a 3% dividend yield. So I want big dividend payers, but I want to be safe. I want that good payout ratio. So I'm going to go, I'm going to go up here under fundamentals, and I'm going to go to the corner, and so that's under 70% payout ratio. I'm going to make that under, let's see what happens under 50%. So I'm going to really narrow it down. Well, you can see there's a lot of people paying good dividends out here with these types of financial type of companies. Maybe then I want to limit my market cap then to just the biggest, as an example, mega, mega, mega. Oh, nobody's falling in that, so now I got to go to large. Anybody there? Yeah. Okay, now I've got a couple sheets where I can continue to lower that down. I'm in the whole financial sector, which includes foreign regional banks, real estate investment trusts, asset management, life insurance. So that's a lot of different companies. Maybe I want to put that down to something more limited. And once again, I can go to the industry. I mean, the sector is financial. In the industry, let's say I'm looking at, you can see these different options as far as these different industries. I'm looking at, let's say, a bank. So let's say I'm looking at regional banks. This you can see them detailed as far as where they're at. Let's say in the Midwest, the central part of the United States. Keep fall up. Sorry about that. So let's say go in the regional banks in the central part of the United States, and I pull that up, and then that'll narrow my search. That'll narrow my search down. I was just thinking about it for a second. So you can see you can have these different choices up here as far as how to do these different types of things, how to search and how to analyze stuff. So the key parts is to really look at this first part under description, these different things you want to change. Then go into your fundamental, which is looking at these different ratios to sort it down further. And then technically, I usually use beta, but you can look at some other types of moving patterns or chart or changes, especially if you're into charts and doing charts and things of that nature. So with that, this is a little overview of FinViz. We're going to use a little bit more, looking at some individual stocks here in a second, but understand FinViz is really nice as far as a screener to really kind of give you a good overview of different stocks. And you can see much more powerful to play around with. So I encourage you to kind of try some things and play around with FinViz. In this lesson, we're going to do a demonstration on buying a dividend type of stock. And with all these kind of demonstrations, I'm not recommending any particular stock or anything of that nature. Really want to just show you some of the process that I might go through or others go through so you can use it for yourself when you're looking to make your own stock picks. And in this one, we're going to look at dividends, and we're going to look at a dividend stock. We're going to focus on the healthcare area and large pharmaceutical just as a demonstration and really show you the whole thought process behind it, both quantitatively and qualitatively as well. But first we'll start with doing some basic research on some stocks and using the screeners to kind of narrow our choices down so we can really focus more on learning about stocks that might pay dividends in the category we're interested in that might be of most interest to us without trying to search through thousands of stocks. So let's get started with it, and let's start with using FinViz, the advanced screener here, to take a look at that. Okay, let's go ahead and take a look at narrowing our choices down. First off, as far as looking for a dividend-paying stock, I'm looking here at FinViz, a nice good advanced screener, finviz.com/screener. And as you can see, they give you lots of different choices and things you can use to narrow your choices down to kind of identify and then research some stocks a little bit more. Because right now, if you look at the bottom, there's 359 pages plus of 20 stocks on each page from all over the world, USA, France, Canada, and more, all beyond Europe, you name it, they're there. And we need to narrow this down to kind of help make our choices. So for this education thing, I'm not recommending a particular stock, just going to use it for education, how we walk through maybe how we might want to look at a dividend-paying stock. And we're going to say we're looking at the healthcare area in pharmaceuticals, drug manufacturers. So first thing we do is we could pick our sector, right? So we go here in the middle here under sector. You got different sectors like consumer goods or financial or technology, you name it. But let's say we want to go to healthcare here. So we're going to click on healthcare, and voila, it's already changed. It's updated. You see the sector is now all healthcare in this column here. Our choices are now down to like 38 pages there. Still a lot of choices. So we need to narrow that down further. So let's say we want to look at large drug manufacturers. So we're looking at drug manufacturers major versus, let's say, medical devices or something else. We're looking at drug manufacturers, large pharmaceutical companies. And you can see we're starting to see a lot of name brand ones here. We still got a lot of choices though, so let's say we want to narrow that down even further. Well, since we're looking for a dividend stock, we should look at dividend yield. I mean, if it's not paying a dividend, we're not interested in that. So let's look at dividend yield, and maybe we want to put in a number for a certain amount of a dividend. We went over a 3 or 4%, pretty high dividend. Let's say, just to start off with, we want at least something that pays us 2%. So we're looking for a 2% dividend. And now our choices are even smaller, right? Now we're down to 10 choices that we can continue to research as far as stocks that are in healthcare, large drug manufacturer that pay at least a 2% dividend. So any those stocks that don't pay a dividend at all or less than 2% on the yield, getting us a return of a 2% return with the dividend, those have been eliminated. So now we've narrowed our choices down. And maybe I want to look at a certain market cap. Maybe instead of these 10, I just want to look at some big companies, the biggest of the big, because I want maybe I want a safe company, a company that's a pretty big company that's been paying that dividend for a long time. So I could choose like large cap, mid cap, small cap. They even have a category for the super big, mega cap, so which is an extension of the large cap. So let's go to the mega and let's see what happens with our mega. Okay, well now we're down to 3 choices here, and 3 big name mega cap drug manufacturers here. We've got Johnson & Johnson, Novartis, out of Switzerland, and Pfizer. Big drug companies, big international drug companies that do a lot of things. You probably might recognize some of these names, if not all of these names. So these are all paying this 2% dividend, so I've narrowed those choices down a little bit. If I wanted to, let's say, go out even further, I could go beyond some of these things. I could go under fundamentals, and maybe if I'm looking at a dividend stock, things that might interest me might be the payout ratio, which is over here. You can look at price to earnings, and the PEG ratio is great here. If you're looking for a value type stock, you want to look at PEG ratio, price relative to its earnings growth. You'd be looking for some of the low price relative to its future earnings. But let's say we're looking at payout ratio, which basically will tell us, what's the likelihood that they're going to continue to pay that dividend? How much of their earnings are they paying out in their dividend? And we typically like 70% or less as far as paying out on the dividend. So let's see if anybody qualifies for that 70% or less. Certainly 60s and 50s are even better, but let's do 70%. Okay, so I chose over 70%. That's the wrong way. We went the wrong direction. So we don't want that. We want somebody who's paying under 70% in their dividend payout. And that left us with just Johnson & Johnson, actually. So, you could, I'm not saying that's where you make your choice. You want to look deeper into 3, but it's interesting that they're all paying dividends, but Johnson & Johnson's only one under 70%. If we were to go down further, if we were to say, gosh, is it even under 50%? No, you see, we have nothing there. So it's not super, super duper low. Let's go to 60 and just see if it pops up, if it pops up there. And it does. So we know it's at least under 60%. So that's a pretty good payout ratio. But since we want to look at these other companies, let's leave that at any right now, because we want to still at least show these other 3 companies, even though they might be paying a little higher than a 70% payout ratio. That's not the end of the world, just something to be aware of. Okay, so I've got information in there. Maybe from a technical standpoint, I want to go in here and I want to narrow my search down further, and I'm looking at beta, and maybe I want somebody who's going to be at a beta of 1, of 1 or less, or if it's at 1, it basically is the same risk or volatility as the market as a whole. So, things, if you want something less risky, which you might in a dividend stock, you might want a beta under 1, for example, less risky or less volatile than the market as a whole. Let's see if that does anything with our updates. And they all have a beta under 1. So that's great news. So, not real volatile stocks. They're not going to not be real risky stocks. They're going to pay that solid dividend, at least 2%. Big companies, though I did like the Johnson & Johnson having the low payout ratio. But now let's look further. Now we've got maybe 3 companies. We've narrowed it down to, you can see on this overview tab, this middle ribbon here is how we're going to compare and look at more detail now. Now it's the next step. We've narrowed our choices maybe to 3 with Johnson & Johnson, Novartis, and Pfizer. You can see some initial numbers like the price to earnings. You can see Johnson & Johnson has a lower price relative to its earnings. That makes it a better value in terms of stock as far as what you're paying for it versus Novartis and Pfizer. And you can, kind of see volume and some different numbers as well there too. So let's just start going through this ribbon here, because this is going to maybe show us some more stuff. First is looking at valuation, some of these valuation ratios. We looked at that price to earnings. We saw that was lower. You can see in terms of market cap, Johnson & Johnson is even bigger than Novartis and Pfizer in terms of market cap, much bigger, big established company. Forward-wise, looking forward for this price to earnings, Pfizer looks like it's going to come down as far as its forward-looking price to earnings. Once again, that PEG ratio, if you're looking for something that's a lower price relative to its earnings growth, that's really true when we look at value stocks. So if you want a little value part of that, maybe something that's a little bit on sale, you can see Johnson & Johnson does well there too, lower than the other two as far as price relative to its earnings growth. And you can see these other valuation ratios too. Price to sales, price to book are the two big ones. Price to cash flow, and once again with those types of numbers, you want it to be lower price relative to its sales, relative to its actual book value. And you can see that's where they diverge a little bit. Pretty similar here in sales. Pfizer a little better. Price to book, nice value here with Novartis. Though once again, its PEG is pretty high too. So I would be wondering about that. In terms of pricing. And then you can see like earnings per share over the next 5 years, earnings per share, growth and all that. And you can see some okay numbers there. And so it looks like they're making money. And so these are big drug companies making money, which is something we want because we want them to pay our dividend. Now we want to go to financial. Let's look at financial. And you can see the dividend payout ratio. So we said we wanted it to be at least not dividend payout ratio, dividend yield, or how much is the dividend going to pay us in terms of, you almost think of it like an interest rate, how much is it going to pay us a return on our dividend if we own that stock per share of stock. And you can see we wanted at least 2%, and that's how Johnson & Johnson got in the mix because they're at 2.69, but Novartis and Pfizer are higher. They're at 3.34 and 3.50. So right now, if I was to buy those stocks, Novartis and Pfizer, I'd be getting a dividend yield above 3% or a little better than Johnson & Johnson. So yeah, Johnson & Johnson has a better payout ratio. They're more likely to continue to pay their dividend possibly. But Novartis and Pfizer are paying maybe a little better dividend. That's not the whole story. We're going to look at what might happen with the price and other things. There's a lot more factors. But right now, if you were looking just at yield or chasing the highest dividend, well, the winner there is Pfizer. They got the highest dividend. But as we saw, there were some other concerning things with them. If you look at like some of those financials like return on assets, return on equity, or return on investment, you can see, yeah, Pfizer pays me a nice dividend, but look at these other numbers which might lead to a higher stock price and certainly better safety and things in the future. Johnson & Johnson is just killing them in these other numbers. Bigger number is better. And if you start looking at, let's say, the quick and the current ratio and the quick ratio, which is short-term debt, can I pay my short-term bills? You want that number to be higher. And you can see, once again, Johnson & Johnson killing them again. So I'm taking a little more risk possibly here. We'll look at risk. We'll look at beta in a second. But you can see I might get a little more dividend, but I'm giving up on some of this potential price appreciation or taking more risk. Now, unless Johnson & Johnson was carrying a ton of debt or something long-term, and they're not. They're all very low in long-term debt relative to their equity. So those are all really nice, good numbers. I wouldn't be worried about any of them. They're all very good in terms of their long-term and their overall debt to equity. Profit margin, another key number that we'll look at. That means each sale you're making a little bit more on each sale. Johnson & Johnson running a little bit higher, a significantly higher profit margin, which means as they make sales, they got more money flowing to earnings, which means that money can flow to our dividend, and maybe there's a chance of them raising dividends, and that's something we want to look at if we're looking at dividend-paying stocks or be aware of. And this is just relative, short, current prices and price change. We want to look at more a longer-term performance, which we will in a second. All right, so Johnson & Johnson, lower dividend, but a lot better in other numbers. Right now is how I'm seeing it. Right now, that's what I see. Recommending, I'm just saying this is what we're seeing when we narrow this group down. Ownership gets you an idea of how much is in-share shares, how much institutions own. You can see, a lot of these are owned by big mutual funds and all that. Are things to look at, opposed to Novartis isn't, but others are. And then we click on performance here in this middle ribbon, and this gives you some more recent numbers, short-term things. Then this is just a moment in time, so this could be, when you look at this, every day the price changes, so these numbers change, so don't try to replicate this, but when you look at it, you'll see these numbers. It'll give you like the previous quarter, or performance for the quarter, or half year, or year, or year to date. One thing when you look at, like, let's say like year to date, is think about where in the year you're looking at it. How many look at this later in the year, so this number maybe has a little bit more weight to it. Still, it's a very short-term number, versus if I looked year to date in mid-January, well, that's only a few weeks. That's not going to tell me really anything. A better number, at least from what you can find from FinViz, from the initial thing is a performance over a year, over a 1 year period. You still might want to look deeper into these stocks and look, at the individual sites, their plans, and look how they've done over the last 3 years and 5 years. Particularly, you might want to think about what are they going to do in the future, because that's really what matters. Is what's going to do in the future. But it's still an indicating number as far as, let's say, performance over the last year. And let's see, Novartis is down 8.7, so maybe that's a good value buy opportunity. If you were thinking, well, they're down, maybe they're going to come back, they pay a dividend, maybe I can get them on sale a little bit. That's one way to look at it. Another way to look at it is maybe they're struggling and having looking at those other like return on equity and looking at some of those other numbers, maybe they're just not being very successful. I'd want to look and see if are they having problems getting approval on certain drugs, or did one of their big blockbuster drugs now become where people can make generics of that drug is big in the drug industry. So what's going on? You'd need to dig deeper. But right now, they stand out as far as being negative, and maybe that's a buying opportunity, or maybe that's a stay away from them opportunity. As in, there's no opportunity, you got to stay away. Pfizer ran about 10% over the last year, and Johnson & Johnson, wow, up 31% over the last year. So at this moment in time, once again, anything can change on a daily basis, but it's showing, there's some good recent performance from them. Technical, it gets into some of the real kind of technical, especially getting into like charty, over a 52-week thing. What I look for in the technical is the beta here on the left. That's, once again, you want it to be less than 1.0 if you want a less volatile or less risky stock. If I'm buying like a dividend paying stock, I want it to be, something that can raise dividends. I want something to be maybe less risky, let's say, for example. They're all under 1.0. They're all good. They're all going to be less volatile. Novartis a little less than the others, but this is pretty negligible numbers. It's not like they're running like 1.5 or something big. These are all less volatile, less risky stocks, things you can sleep at night on. Custom would be more making kind of custom type stuff. You have to you can get a little bit in there, and you can adjust type things. Charts is just going to show you a chart here, and you can see Johnson & Johnson over that last year pretty up, a little down. Novartis was up high and went, whoa, so what happened, but they've come back. And Pfizer is down, and now they're kind of on an upswing too. So you get a feel for the chart. Tickers is just basically just their ticker symbols that we've seen here, Johnson & Johnson, Novartis, Pfizer, is all that is. And then this is just some basic information that you want to get the chart and then the detail information on one page, so you can easily scroll through if you want to just see it all real quickly without having to go through the different things. And then there's news and stats you can pay extra for and get more stats, or you can just go right in a snapshot here and you get a chart, you get their summary, you get their news right here, whatever might be recently in the news. You get a little description of the company. So if maybe you know Johnson & Johnson, but you're like, I don't know much about Novartis. Tell me about Novartis, and I'll tell you what they get involved with and some of the things they do, and at least give you a start on that. And the same with Pfizer. We know they're all drug manufacturers, but they might do other things. Like Johnson & Johnson, a big arm of them is doing things like in consumer goods beyond just being a major manufacturer of drugs. So this is the first step to kind of narrow our field down, into some choices, and then you could research them a little bit more. Right now, I would say, Novartis might stand out if I was looking at something that might be undervalued as far as, the price is down because their stock went down. But then if I look at their price relative to their earnings growth, that's higher. And so that would concern me. That would make me kind of stop. And I'd worry about their payout ratio being over 70% if I'm looking for a dividend stock. Whereas, certainly, Johnson & Johnson pays me that less dividend, a 2.69, but it's still a nice dividend, and it's a growing dividend. If I research into them more, and I have done research just in prep for this, Johnson & Johnson has paid out a dividend and raised their dividend for the last 53 straight years. I mean, that's pretty impressive. We're going to go to their website here just so you can see what they do. And so that'd be impressive. So I would weigh that pretty heavily, that they're going to continue to pay that dividend. Sure, it's a little less than Pfizer, Novartis, but maybe that safety of them paying it is real important to me. Also, if you qualitatively, if you know the company a little bit, you can learn more by kind of going into like their products and things of that nature. Here we'll go into consumer care products. A lot of people know Johnson & Johnson, like Johnson & Johnson baby oil. If you know them for that, they do skin care, and this is beyond just their manufacture of the drugs. We'll look at that in a second, but you can see they got a diverse type of stuff they do. They do Band-Aids. Where I live, we actually call them Band-Aids. We don't call them wound care or adhesive care, whatever. We call them by their name brand, which is Band-Aid. Johnson & Johnson. How powerful is that brand of Band-Aid? So they have that. Listerine they own. Tylenol certainly is a big, over-the-counter drug that's out there. But they got some other big ones too, like Sudafed, Pepcid, Melanta, Zyrtec. Some of these, Imodium, you might know some of these in Envision Care as well. So Johnson & Johnson does a lot of different stuff, from medical devices, prescription products as well. The thing with Johnson & Johnson is, okay, now we've done some analysis with all three companies. We'd want to do the same thing where we want to learn more about Novartis and Pfizer too, and what types of things do they do. And that's the thing. We've now done some quantitative or numeric type analysis and narrowed our choices down, which is a good thing. I'm not having to search through hundreds and hundreds of healthcare stocks, let alone thousands of overall stocks. I've narrowed it down to these three, but now I need to learn more about the individual stocks before I can maybe make a choice. If you think about things like qualitatively, there's some things I need to know beyond just the numbers. Like, myself as an investor, how smart am I in this industry? Do I know the pharmaceutical industry well, beyond maybe just taking some cold medicine or drugs? How well do I know the company and going on their websites and looking at their annual reports, looking at their forward-looking statements? What do they mean as a company? What are some of their strategies? What does the future trends look like? I know for, let's say healthcare in this example, future trends are people are getting older and they're living longer. So that means they're consuming more healthcare products over their lifetime. That's a good thing for pharmaceutical companies. That's a win that will help their sales, so to speak. And overall, all this, it's got to fit in my portfolio. If I have a portfolio of 90% healthcare stocks, I probably don't want to add one more in there, even if it's a pretty good one. And not to get caught up in things like what's hot or what's cool or what's maybe a product I like. Maybe I had a headache and I took some Tylenol and boy, it cleared up my headache. And I'm thinking, wow, that Tylenol is great. Who makes that? Oh, Johnson & Johnson. I'm going to buy their stock. Because it was a great stock, or maybe I liked another product, Pfizer makes Viagra or something like that. Maybe you like that, whatever it might be. So the thing is, it's an art and a science to investing in stocks. Of course, the things will help you with that. And doing this analysis, and with anything, particularly like a dividend stock, you want to think about, why am I buying this? And what are the dividends going to do for me? Am I going to reinvest those dividends? And really think about where it fits in that overall portfolio, and importantly, overall in your goals. But here was an example of, as far as buying a dividend stock. You could then replicate this in different industries or looking at different stocks. You can do this lots of different ways. In this lesson, we're going to look at buying a value stock, something that's on sale, so to speak, that might be really beaten down. Maybe they've had some bad news or something has happened that's caused the stock price to go down. And the idea of buying value stocks is we want to buy these stocks on sale with the idea that the stock will come back and rise in price. But a very good chance with value stocks, and something I would be aware of and maybe budget for, is that they'll continue to go down at least a little bit. It's hard to buy at the exact bottom. You might be buying near the bottom, but they'll go down a little bit, but the idea is that they'll come rebounding back and then continue on and be maybe a great stock for you, maybe a great stock long term. But to do that, we need to kind of narrow our field down. There's thousands of stocks out there, and we need to kind of compare and analyze that stock maybe against an industry or maybe against the leader in the industry. And that's what we're going to do in this particular lesson. It's a demonstration purposes only. Once again, not recommending any stock, but we can use this for demonstration looking at a value stock. And this one, we're going to look actually at a company called Skechers. Skechers makes tennis shoes and athletic stuff, and mostly shoes. And they're a big player actually in the United States. They're number 2 in the United States in terms of athletic shoes. The number 1 player, number 1 overall worldwide by far, is Nike. And so we'll kind of do some comparison there. So first thing, let's go do some quantitative analysis and kind of see what the numbers tell us with Skechers. Okay, so let's start doing a little look here at Skechers. Their stock went way down. They had a bad earnings announcement, went down only 27% after their earnings announcement, and we want to look at that and see if there's a value play here. Is there a way to buy the stock kind of on sale? And we're going to look at some numbers and things to kind of narrow our universe down here real quick. And we can actually do that real quickly and real easily at finviz.com. Nice little stock screener there. First off, about Skechers, got their website here. Skechers, they do shoes. They do apparel. Like athletic shoes. They're actually the number 2 supplier of shoes, of athletic shoes in the United States, behind the industry and by far world leader Nike, but they're actually ahead of Adidas in the United States at this period of time, because things change all the time, of course, but right now they're there. And look how happy she is She loves her shoes. Maybe we should buy their stock just because she loves those shoes. Well, maybe not. Maybe we should do our due diligence and do some quantitative and qualitative research. So first off, this is a value stock. So we want to, it might be down in price and all that. We're kind of looking for that. So let's take a look at this. Now, FinViz is a nice way to sort. We're going to compare them to Nike. Now, we don't have to go through our filters and things and put in a lot of information. We know the two stocks we want to look at. Let's say in this case, Skechers and Nike. So we can narrow that universe down and just get to those two. You can go right over here where it says ticker up in the upper right here, and you can just put in the 3 or 4 letter ticker symbol. You can go to Yahoo Finance or on Google, and you can look up Google Finance. You can find out their ticker symbol pretty easily from that. That's just a short abbreviation. I know Skechers is SKX, and I'll put a comma there. NKE is Nike, so I've got Skechers and Nike. I hit my enter key, and boom, there it is. Right here, Nike and Skechers. This is just listed by alphabetically at this point. They're not saying Nike is better than Skechers or anything at this. Is just how it lists it in here. And you can see they're on consumer goods. They're in apparel. Both the U.S.-based companies. Market cap-wise, you can see that Nike is huge, $93 billion. Skechers, decent, $3.4 billion, but certainly a lot smaller than Nike. And they give you the price-to-earnings ratio and the current price, and that's right there. So what we want to do is look at this middle ribbon here, and now start comparing and looking for some numbers in terms of things that might help us if we're thinking about buying a value stock and we're thinking about buying Skechers for example. Here we're going to first off look at valuation, right? What's the price relative to its value? And this is where you see things like price to earning and PEG ratios and all that type of stuff. So we see Nike's got a 25.64, pretty high price to earnings. Skechers not bad, 12.27, actually a good size, good price to earnings. If it was below 10, even better, but it's not like it's crazy high, its price relative to its earnings. So that's a good sign. We're looking for low price to earnings. We're looking for like a low price to book or low price to sales because we're looking for that future, and also a low PEG ratio. If we were talking about price to sales and price to book, let's start with those. You can see those are right here. And Nike's pretty good value. You're paying for Nike. You're paying for that brand when you're buying that stock. Skechers real low, on price to sales and price to book. So its future sales is price relative to its sales, the underlying assets of the company in terms of book. Good. If I'm buying a value stock, I want something that's got some meat underneath the bone, so to speak. That it's got some solidness to it without. Though I know it maybe has been hurt on bad news or something has happened to the company or it's out of favor for some reason. A good number to look at that a lot of value investors really like is the PEG ratio right here, the price relative to its earnings growth. Am I paying a low price relative to its future earnings? Because those future earnings and the growth of earnings is what drives stock price up and other things that drives investors, drives future things, maybe even like dividends or reinvestments in the company. So a low PEG ratio is real important to a value investor. And certainly something that's under 1 is what you're looking for. Anything below 1.0 and a PEG ratio is good. You can see Nike here is at 1.82. That's really high. That might be something for like a growth stock or something like that where it's pretty high price, but you're expecting even better growth or something. That's not a value stock at all. Maybe it's a dividend stock, Nike might be, but maybe not. But certainly I wouldn't consider it a value stock looking at these, relatively high price to earnings or high price to earnings, and it's very, high PEG ratio. A low price earnings right now is nice for Skechers, but even better is that PEG ratio of 0.61. I like that. That's telling me I'm getting a good price. I'm getting this stock on sale. Doesn't mean I'm going to buy it or anything. I'm just saying this is a good initial indicator of something to look for when you're looking at a value stock. It should be on sale. It's out of favor for some reason. You shouldn't be paying a premium price for it. Otherwise, we can also look here at things like earnings per share over the next 5 years, the past 5 years, but also the future growth projections and things, and they're predicting nice growth for Skechers at 20% versus 14. So that's a good sign too as well, that maybe I'm going to buy a stock that's on sale, but I can get some good earnings in the future. And then we go under financial here, and here we want to look at some of their efficiency things and dividends. So here, first thing, dividend. Well, Nike pays you a little dividend of 1.16 there. Not much. It's not a big dividend payer, but it gives you something. Skechers doesn't pay a dividend at all. So if you're looking for a dividend, and you can get dividend stocks that are also value stocks, that are underperforming or underappreciated. In this case, you're not going to get any dividends. So unless they have a dividend in the future, I wouldn't count on it, but anything could happen. But also, you're really going to make all your money on capital appreciation, buying low, selling high. So down the road, maybe years down the road, but you want to buy low on this stock. So it's real important, especially since it's not paying a dividend. You can see Nike is a much more efficient running company. It's return on assets, return on equity, return on investment. That's management functions better than Skechers, right? So you can see those numbers. I mean, not bad. I mean, you got 19 ROEs, not bad, but Nike would be better there. One thing that's important I look at when I'm looking at, say, a value stock is, can they make their bills? Can they pay their bills? Can they pay their long-term debt? Because sometimes a stock is out of favor because it's struggling financially to pay its bills and it never recovers and goes down in price, maybe even goes out of business. So looking at things like around debt and paying their bills is important. You find them here with the current ratio and quick ratio, and you want these numbers in current and quick ratio to be higher. The higher the number, the better, comparing assets and liabilities and that kind of stuff. And you can see Skechers is right there with Nike, and right there pretty good as far as its current and quick ratio. It's not low numbers here, so that's a good sign they can pay their bills. Anything can happen, but right now that's a good sign. And then also looking at their long-term debt and their debt to equity ratio. You can see low numbers here, real low debt for long-term. That's a great sign. I like that because that means they're not having a big debt firestorm coming their way, years down the road. They're carrying right now low debt. Now, management could change their mind any time, of course, but tomorrow all of a sudden taking a bunch of debt for some reason. But right now they're not carrying a lot of debt. So no dividend, but I got a low debt ratio, nice current payment. I saw in those other numbers some nice PEG ratio, so that was pretty good. If we look at performance here, let's see how the recent performance has been. Once again, year-to-date numbers and these short-term numbers, you got to think about when you're looking at that. If you're looking in February, you've only got a few weeks of data, so I don't usually look at the year-to-date number. At least this is the year over the last year, and you might want to dig deeper in Yahoo or other places to find 3 or 5 year type numbers. But this is over the last year, what it's doing currently. You can see Nike's been down here too, so Nike's down at 3.5. But look at Skechers there over the last year, at least at this snapshot in time. It changes every day. But in this snapshot of time, wow, they're almost down 55% over the last year. Holy moly, that's really down. If you bought high up there, you're down 55%. That's a bummer. So you got to ask yourself, somebody's buying and somebody's selling. Well, most people are selling, it looks like here. So as a contrarian or somebody doing the opposite of what the market's doing, you're looking for a value or unappreciated stock, a stock that's on sale. You could look at this number and be encouraged and say, wow, they're down 55%. Maybe they'll go down further, and I'm okay if they go down a little bit further. But then when they come back, they'll have potential for big gains because they're down so far. That's how a value investor would look at it. Or somebody might look at it and say, wow, they're down 54%. They could keep going down another 50% or 30% or more. Maybe this is just a bad dog stock, and I want to stay away. So that's why looking at some of those other numbers like the PEG ratio and their debt and their current payments and all that kind of stuff are important when you look at it from a numerical or quantitative standpoint. And then we'll talk about qualitative in a second. But 54%, well, that really stands out. Technical analysis, there's a lot of different things you can look at technical, like charts that's there. I look at here for the beta, how volatile is it? And nice thing, Skechers really low beta, 0.15. That's surprising. I thought it would be a higher beta. 0.55 is actually very low for Nike. Anything under 1.0 means it's less volatile than the market. It means the price swings less than the market. But it might be just because Skechers is kind of going down a little bit. But it's a very low beta versus, let's say, a high growth stock that would have a high beta above 1 or 1.5 even, a high beta. So that's good as far as volatility on there. And you can look at like charts or do some custom things. We'll look at charts. Here's Nike, Skechers over the last year. You can see how Nike's kind of gone up and down, bounced around a little bit. And Skechers was bouncing too. Then they had this bad earnings announcement. They missed their earnings, surprised people, and went down, just went rocking down. And people in the market don't like when there's surprises. So there was a surprise here. And now you have to ask yourself, does this mean this is a buying opportunity? Is this more like plays in this range? Or is it going to keep going down? And that's part of why we're doing our analysis. You can get news and other information here. A quick way to get it is just to click on Snapshot, and it shows you your chart. It shows a summary of stuff, of the financial information, all those different numbers. It shows your news right here, so you can look at news, and it has a little summary of the company too. You want to dig deeper in this, but it's a nice little quick way to get information, insider trading as well. Here's Skechers. You can see that big drop off here, financials, different kind of news things. Now I don't buy everything in the store in the stories. You got to take that. But here's like here's an article. What more pain could be ahead for Skechers stock? What more pain could be ahead for Skechers? So that might be something I'd want to read to learn a little bit more. It might not influence me, but it might be something worth a look at. And then you've got a summary of the company as well too. So here's some financial information, some numbers we looked at. I certainly like that. that low PEG ratio I thought was pretty intriguing if you're a value investor. Once again, that low PEG ratio, looking at those better current ratios, quick ratios, long-term debt was good. Certainly its return equity and all that not great, but you can't have everything. And I'd have to ask myself, is this stock going to keep going down, or is this maybe a time to buy it on a low turnaround? And buying it near the bottom, but you can't time the market, especially if I was going to hold the stock maybe for a long period of time. I could say I could weather the storm longer and maybe do better in the future with this stock. And that's really the thing with investing in stock when you think about it now qualitatively is, how well do you know the industry? How well do you know the company? There's other factors beyond just the raw numbers as well too. If you look at it from a fundamental standpoint, a chart person would just look at charts. They wouldn't even look at all those numbers. They'd just look at patterns on a chart maybe is what a chart person would do. But if you're looking at fundamentals, you look at the numbers, and then qualitatively I look at the industry, the company, what's happening in the industry. Is there new changes in the industry? Is the industry growing? Are they growing in new markets? Is the company growing into new markets? Maybe internationally, maybe that might help them. If they're good in the United States like Skechers is, maybe they have great potential for growth outside the United States. That might be something I'd look at like future trends and things that might be happening around that industry. I'm not an expert in the apparel industry or in the shoe industry. My son owns a pair of Skechers. He likes them. I've owned some Nikes. That doesn't mean I know those stocks. It just means I own some shoes, I guess. And that's the thing about that. You can't buy or sell stocks based on just what's hot at the time or what's cold at the time or something like that, or because I like the product. Maybe I bought some Skechers and I walked around them and said, this is the best shoes I've ever worn. Well, maybe I may be interested in the stock on that, but don't buy a stock just because of that. That might be one reason beyond that, and you want to learn more about the company and all that because your taste might vary. And that's the thing with stock buying. It's an art and a science, so you're kind of combining them together. But if we looked at, like in this particular example, I hope you saw some of the things I was looking at, talking out loud on that, some of the ratios I was highlighting for a value stock, like a PEG ratio, on something I might not highlight for a different type of stock, like a dividend stock or something like that. You can see we didn't talk really about dividends at all because we're looking for a low price with a high price appreciation. So no recommendations on either Nike, Skechers, or any stock, but I hope this helps you, and then you can practice and try on your own to look at stocks maybe that interest you and start these comparisons and seeing what you see. And hopefully that helps you in your stock and your investing journey. Okay, now in this lesson we're going to look at buying a growth stock as a demonstration. You kind of see what kind of the process I go through, or start seeing some of the things I start talking about and looking at. And we're going to look for a growth stock, so a high-flying stock, a stock that we hope will maybe change the industry a lot or become a big player in there, or maybe change the world for all we know. But the idea is we're taking more risk on this stock. It might not have anything as far as current earnings even, so we're going to look at a stock that has some high potential. It's what you're looking for growth stocks. They're already probably maybe pretty priced high. The market is seeing this, and you might be saying, do I want to continue to ride that wave, or will it turn and change for the worse? So we're going to look at growth stocks, which tend to be a little bit more risky as well too. And we'll go through a demonstration, not a recommendation. Don't recommend any particular stocks, but we'll go through it as a demonstration. And in this case, we're going to do this demonstration looking at Tesla. You might know Tesla as the automobile manufacturer. They make high-end electric cars. They typically start around $80,000 or whatever as far as an electric car, a high-end sports electric car. But they recently, or not recently, they announced they have this Model 3, which is a big a big $35,000 car, something lower price, and that's really caused the stock to really react positively in that initial short term. And we might be thinking, oh, maybe they can make a car that's more affordable to the masses, at least at the high end of the masses, not an inexpensive car, but it's still an electric car. And maybe that's going to be something that will change the industry, maybe change the world. Tesla's done a lot of stuff as far as changing the industry, looking at maybe selling direct versus, let's say, selling through a dealer network like they do in the United States as an example. So we'll look at Tesla and we'll compare it to an old kind of company, Ford Motor, and less of a high-end growth company, where Tesla's more because they're trying to do something new with electric cars and other things around electric vehicles and batteries and other things that they're looking to do. So let's compare these companies, and let's start by looking at some of the quantitative or numerical analysis. Okay, we're going to start by doing some quick analysis of Tesla, and we'll do a comparison with Ford here at finviz.com/screener, nice good advanced screener to kind of sort through some stuff. But to do our quantitative or numbers, then we'll look at some qualitative stuff. I happen to have Tesla's website up here too. If you're not familiar with Tesla, they build beautiful looking, I think really nice looking electric vehicles. It's all electric, no gas in there. And for as a high-end sports car electric vehicle, and you can see these different models that they have out here. And what's generating a lot of excitement is this Model 3. You can actually pre-order these vehicles, these Model 3s, and something that's starting at like $35,000 as far as a car that's a full electric car with giving you, it says here 215 miles of range for like $35,000 US, and it's caused a lot of excitement and a lot of buzz in the industry out there. So that's Tesla's Model 3, and as far as taking a lot of orders on that, as far as without selling them, but taking pre-orders on it at this point in time. So let's look at some numbers now. So here we are at FinViz, and we're going to type in the numbers here. So we don't have to do a big stock screening thing. We don't have to go through the automotive group. We're going to go in the upper right here where has the ticker. You enter the ticker, or you can look that up on like Yahoo Finance. Look up the company. You can find its ticker symbol. I know Tesla has TSLA, and we'll compare it to Ford. old automobile company. Pretty good company in a lot of ways, but their ticker symbol is just F. So we'll hit the enter key here, and we'll compare Ford and Tesla, and you should see probably some pretty significant differences between them. You can see in this particular time, Ford's gotten a lot of volume versus, like, so let's say Tesla. When Tesla announced the Model 3, their volume just went, as far as their stock trades in a day, went crazy. So you can see they're both in consumer goods. They're auto manufacturers is where they place Ford and Tesla. Once again, this is not a ranking. This is just alphabetical when you see this first list. So let's start looking at this, and we're looking at this for Tesla to be a high-end growth company. All right, so this is something where we want the price to appreciate on our stock price, and we might not get a dividend. In fact, we should expect no dividend on a high-end growth company. So let's take a look at that, and first we'll look at some of the valuation numbers. What's the price look like? You can see first price to earnings number. You can see Ford has a really low price to earnings. They're really kind of a good value right now if you're looking at price to earnings relative to its earnings, well below 10, certainly in the 5.38. So that's something interesting. But we're looking at Tesla, and you can see, and this will be very common with some growth stocks, they might not have any earnings yet. In fact, Tesla has not made any money ever, at least at the time of doing this. So their price relative to their earnings is not applicable. It's in effect zero because they have a price. Sure, you can buy them, but the stock, but they have no earnings against that. So when you look at things like price to earnings or price to earnings growth, which is the PEG ratio, you can see no numbers there. If you're looking at value stocks, by the way, a value stock something under 1 for a PEG ratio, Ford at 0.6 seems interesting there. So maybe more of a value play. But Tesla, we're going to look at it as a high-end growth play, something that's going to change the world, and we want to be on the ground floor on that. So, but we're not saying a price to or earnings, so we can't look at those numbers. We look at price to sales and price to book. It's certainly better than Ford and their price relative to their underlying assets, especially book. You're getting a pretty good price. They've got a lot of underlying assets. They own a big solar manufacturing facility and all, or not solar, a big battery manufacturing facility and expanding that. And actually, they're in the process of buying a solar company, which is a qualitative thing we'll talk about later. But you've got a good chunk of assets there. And future sales and future earnings per share over the next 5 years, they're expecting some high growth there. We'll see if they deliver, but that's the idea of buying these guys is, you're not looking at that, kind of slow, nice growth over 5 years of 9%. You want to get paid a premium for the risk you're taking on buying a high-end growth stock, and that's the idea of looking, hopefully, for an earnings per share that's, a nice growth number, like this is, 35%. All right, so that's that. So let's look at financials. Now, dividend, a growth stock should not pay a dividend because they should be taking all that money and investing in the company and to grow the company and really grow their share price for us as stockholders, right? So a company that's established, sitting on lots of cash, will pay a dividend. And once again, more of a value company. Ford's paying a pretty nice dividend at this moment in time. But Tesla, you can see no dividends, and you shouldn't expect a dividend. Return on assets, equity, and return on investment, negative numbers, kind of concerning there. Are we being efficient? Are we, getting some returns there? But once again, we're looking for that long-term growth, but that's something to be aware of. Also, you want to watch out for growth companies that might be taking on a tremendous amount of debt and having a hard time paying their bills and things. So you can see current ratio and quick ratio is paying their short-term bills. You want that to be a number above 1, and you can see that they're doing that fine, or at least at 1 with the quick ratio. So they're paying their bills, but they're not making money, but they're paying their bills. And long-term debt, yeah, they've taken on some debt. It's not a huge number for Tesla there, but they've taken on some debt, and they're using that debt to help fuel their company would be the idea behind it. I would want to dig in deeper into their financial statements and some of the things their CEO, Musk, has said, Elon Musk, around, how are we using that debt we're taking on? How are we using it when we issue stock to, finance the company? And are we using it to grow the company or maybe buy things that help us grow the company? But not scary numbers here. You can see Ford's got some scary numbers up here because they're trying to service a lot of big force of people, a lot of plants. They're also having to take care of people with pensions and things that they have an obligation there too. And so they maybe are taking on more debt. But you can see not bad as far as with Tesla. And profit-wise, you can see they're not making any money yet. They're losing money, right? They have a negative profit margin because they're putting all that money into research and development and building these new cars and building the Model 3. So every car they sell, they're in effect losing money as when compared to looking at an overall profit margin as they build the market and build out their organization. Not uncommon for a growth stock, but it'd be nicer at least if they're making some money too. You might find that in technology where they can maybe turn some profit maybe a little bit faster just because you don't have the hard good costs or the people costs you might have in a big manufacturer like an automobile manufacturer. You can see ownership, who's owning the company and what how much is insiders, how much is institutions, that kind of stuff. Pretty well bought between institutions and regular folks like you and I. If we look at performance here, this is over the short term, and this is just an initial snapshot here. Year-to-date performance, once again, make sure you're looking at when you're buying in the year. If you're looking at January, these numbers aren't very good because there's only a few weeks there. But if we look over the last year, you can see the Ford stock's down, automotive is down, Ford's down 7%, but Tesla's down 21%. And we'll see in the chart here in just a second why that is, but they basically had a big run up with their Model 3 launch and everything, and now they've kind of come back. They've had some other types of issues and things, so they've come back, but maybe it's a growth stock that might be a little bit on sale, down 21%. It's something to be aware of and look at. But growth stocks, they'll fluctuate more. They'll have much more volatility and be bouncing around a lot more. In fact, let's look at technical, which will show us our beta, which will show us some volatility. We should see a number above 1 and maybe a big number above 1, and we do. Tesla's 1.34. Ford at 1.29 is actually disconcerting for Ford. That shouldn't be typically that high, hopefully, for them, but it is. But Tesla 1.34, that's not unusual for a growth company, right? They're going to have fluctuations. They're going to be up. They're going to be down. If this was a low beta, like below 1.0, 1.0 and less means it's less volatile than market. The price changes less than the market, less risk. That would be even better. But this isn't scary bad, but just something to be aware of, that if you buy Tesla, the stock will go up and the stock will go down, and you have to be aware of wild swings with that. It's going to be much more volatile than the market. So if you hear people on the news and saying, oh, the market's real volatile, it's been real volatile over the last month. Well, with Tesla, you're going to be even more volatile than that. So just be aware of that. And then you can do like custom stuff. We'll look at the charts here. You can see Ford kind of went down here, this over the last year, and then bounced back and has been in this narrow kind of trading range here after maybe had bad earnings or something, who knows, and it went down. You can research that and find out. And then Tesla was going down, 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 and then they had this Model 3 in launch, and took off well better than expected as far as pre-orders on that, sight unseen. And look at the stock rocketing up there. That's what you can see sometimes with the growth stock. Whoa, look at it go. But then when do you sell? If you sell. See, now it's kind of come back down, and maybe it's now down here. Is this going to be its price? Is it going to go back rocketing up? When that Model 3 comes, are they going to rocket up? Are they going to go down? Are they going to have other problems? How's the company running? So this doesn't tell you the whole story, but it's interesting to see down, 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 up, up, up. See that volatility there? If I bought here, I'd be like, oh my gosh, what a bad purchase. Maybe I'm going to sell. And then right when you sell, it's like, oh my gosh, I blew it. Look at it go. That's why stocks are for the long term. This is over almost like a 4 or 5 month period. Stocks are longer term investments, particularly when you look at that volatility, and certainly in my opinion. You can get news and information. I like just jumping right to the snapshot because it shows my chart, it shows my numbers all in one place for the particular company. It's got news right here. So if I'm looking at something right here, I can read different articles about the company. It gives me a little description of the company itself, plus maybe what insiders are doing here as well. If we look at Tesla here, you can see that big movement on that chart here, their numbers, different types of information out there that might be going on. Tesla update halts automatic steering if driver is inattentive. They've been having some troubles with their automatic steering. Great technology, cool, but if it doesn't work, it's going to cause the stock to go down. So there's some safety debates and things you can read along that. And there's some things around like over dealership laws and things within, because they want to sell directly. This is how they're disrupting or changing the market, not selling through dealers, but that states and unions and different people are resisting that. Small businesses might be too. So you can see what might be a positive for some might be very negative for others. So if we think about Tesla here, a good example of a growth stock, the idea is, it's going to have low earnings, maybe no earnings, maybe future earnings per share would be good. Financial numbers might be, no PEG ratio or anything, but maybe good price to sales or price to book. and certainly not a dividend payer, and but nice that their debt was pretty good. I like that. The debt was pretty good, though some of their other numbers, efficiency numbers weren't terrific, but good debt numbers there. And then it was interesting. You always see this high kind of beta type number here, as far as the numbers and it being more risky. And that's the thing with growth stocks. If we start talking about this now qualitatively, kind of more gut and more of our more mind kind of coming in there versus the hard cold numbers of quantitative numbers. We learned a lot from the quantitative numbers that we looked at, or we can certainly interpret a lot. Now we got to dig deeper to find out even more. What is Tesla, if we're using this as an example, what are they going to do? What are they doing in the future? I mentioned before they're buying a solar company, people that make solar panels. Is Tesla want to be an automobile company, or do they want to be an alternative energy company? And they make batteries to help, power their cars. Musk, as the CEO, has talked about using the home as being a central place for energy and alternative energy. And is that where solar panels come into play? Are solar panels used in these massive battery factories and these other factories that they'll use, and using solar to help power that as part of an overall strategy? Those are the things you'd want to dig in deeper in and say, does this make sense to me, or does it not make sense to me? And what is the long-term future look at it? Looking back at those basic qualitative things like the industry and the company and what's happening in the overall automotive industry, there could be some big macro events of the overall economy is just in the tank, like 2008, 2009, where we had the Great Recession. Well, all car manufacturers struggled during that time, and a company like Tesla, which is a high-end vehicle, alternative energy electric vehicle company, might struggle even more, which could put pressure on it as more of a startup, more of a growth type company. So things to think about along that, though their debt numbers were pretty good looking at that, so that makes me feel better that maybe they could weather that storm. And what are some of the future trends out there? Certainly future-wise, the growth of alternative energy is going to be continuing growing. Governments support electric vehicles and things of that nature with like subsidies or things to help people buy them. We see that in different parts of the world, and that helps companies like Tesla. But also future might be, if Tesla has great success, there's nothing that prevents General Motors or Toyota or Ford or any of these other manufacturers from trying to get in there as well. Tesla certainly has the cachet like an Apple or Google would have, but even still, when Samsung makes a big play in the phone market, the cellular phone market, for example, that does take market share away from Apple, even if Apple is the market leader. Well, Tesla's maybe the leader in high-end sports car electric vehicles, but if, let's say, BMW comes in, who's to say that they can't really erode that market share, maybe even take it over? And the one thing also, as we talk about like not being hot or too hot of products or cool in products, or read something in the news like Tesla's going to change the world, and you buy the stock, and then all of a sudden it drops in price because you need to do a little more due diligence on it. So be aware of that. You might look at Tesla as a good example, where like, wow, that's a really cool car, and I think that Model 3 is affordable for many people, and that could be a big winner, and I want to be part of that. I want to buy some stock in that. And I believe in alternative fuels and alternative energy and alternative cars as far as electric cars. And those could be all things you feel, which could be very emotional. And you want to take that emotion out of it, because you could see like that chart where it went way down then rebounded way up. If you bought when it was way up and then it went way down so fast, you might sell or not feel comfortable with it. It's easy to say, boy, if I bought at the bottom and watched it rocket up, but you can see it's already down 20-some% from that high just in such a short time. And that's the thing with growth stocks, right? Maybe it's the next Apple, maybe it is the next Google, or maybe it's Pets.com or something like that it isn't successful, or whatever. I can't remember the name, one of those internet bubbles that burst companies, but it's a company that may succeed, may not. It's great to buy Apple when they're low, and you've reaped all that benefit, but it's another thing to maybe buy somebody higher or buy somebody that fizzles and never succeeds. So Tesla is certainly a good example of a growth stock, real volatile, high beta, high growth potential. And when we think about qualitatively, you can also think back, what if they succeed? If they succeed, they could succeed and exceed everybody's expectations wildly. They could change the world, in effect. They could change how we consume or how we use automobiles, and certainly how that might look maybe 15, 20 years down the future. Maybe 20 years from now, everybody's driving a Tesla with an electric motor in it. Who knows? Or maybe Tesla, much like DeLorean, if you know DeLorean, much like maybe other manufacturers of automobiles, just becomes part of history. So either way, a longer lesson here, but I want you to show you not a recommendation for Tesla one way or another, but just an idea of what to look for and maybe what to expect if you're looking at a growth type stock and you're expecting that long-term growth, and some things to think about as you look at those types of stocks as a case study, as a demonstration. Best of luck to you, and best of luck in your future investing.